Welcome, welcome to this YouTube channel. My name is Patrick. The bitter truth is this: if you are new in Forex, not really new, but if you are still in the learning phase in Forex, mistakes are guaranteed. You're gonna be making mistakes and lots of them, and every mistake is going to cost you. But really, some of these mistakes you can easily avoid. And one of these mistakes is trading the wrong pair. Trading pairs you shouldn't be really trading. But the good news is, if you stick around till the end of this video, you're going to be in a state whereby you open a chart and within a second, you just know if you should or shouldn't be trading that pair. And the reasons why you shouldn't be trading that pair or you should be trading that pair. Not pairs only, but can be indices or crypto coins. So please watch till the end, and without any waste of time, let's get to it. So now the main difference in the currency pairs that we trade is in their volatility. And this volatility is measured by observing the ATR of the currency pairs. Now, what is this ATR? The ATR observes the lows and the highs of price at a given point in time. Maybe to be more specific, the ATR, which is the average true range, looks at the lows of the previous 14 candles and looks at the highs of the previous 14 candles and subtracts the lows from the highs of the previous 14 candles and gives us a value which gives us an idea of how high and how low the market is spiking at that point in time, or how the market is moving at that point in time. Now, how does this affect your trading? If you look at this example, let's say you want to trade this chart pattern, which is a flag. The higher your ATR is, the further your stop loss is going to be. For example, right here on example A, let's say A is a chart pattern in a different currency pair, and B is a chart pattern in another currency pair. If you look at example A, the ATR is 110, and if you are to trade this flag, you are going to enter the market right at the retest of the breakout, and you have to put your stop loss right below the support of the flag, as I have illustrated right here. Now, if the ATR of this pair is very high, as you can see, it's 110, the stop loss in terms of pips is going to be away, further away. Why? Because the market is spiking very high and very low, which makes it to be highly volatile, reflected by the ATR. But if you look at B, the ATR is far less. It's 0.0013. And if you were to find the same chart pattern on this pair B, it would give you a far less lot size, not really lot size, stop loss in terms of pips compared to A. Why? It's because this pair is not volatile. It may not be clear if you look at it with a naked eye on the chart. It might seem the same, but if you compare the ATR of the different currency pairs, it gives you a clear idea of the volatility of the market. So on example B, you are going to have a very tight stop loss, but you are trading the same shape on different currency pairs. You are going to have a very tight stop loss, and if you have a tight stop loss, it means you'll be risking less. Now, if, for example, you have $100 account balance and you are entering trade A with a micro lot, which is 0.01 lot size and equivalent to 10 cents per pip, it means you'll be risking 6% of your account in this trade. But on B, you will be risking 2%. Why? Because you have a tight stop loss of 20 pips, but it's the same setup, same entry rules. The only difference is the ATR, which reflects the volatility of price in that currency pair. Now, if you have no clue of how much you should be risking in terms of percentage, I can give you an idea. Most traders, let me say successful traders, trade between 1 and 2 or risk between 1 and 2% of their account in a single trade. You can hardly find them risking anything above 5%. They usually risk between 1 and 2%, and most of them even risk less than 1% of their account in one trade. So that should give you an idea that whenever you see that you will be risking anything above 3% of your account, you stay away from it. So now I'm going to give you the settings, or how you should set your chart, or how to enter the ATR indicator on your chart, because it's a free indicator found on all on the trading platforms, the MetaTrader platforms. So let's get to it. Now, if you look at my chart here, right on the bottom left corner, I have ATR 14, which tells me that it looks at the previous 14 candles, and followed by a value 0.00212, which is the value of the volatility of this currency pair, EuroCAD. So let me show you how you can insert this indicator. It's going to be easy and quick. Alright, here is your chart with no indicators. What you do is you go to this F sign, which stands for function or indicators. You go to this F sign and then you look for average true range, and it is right here under oscillators. So you click that average true range, period 14. Now the period simply means the number of candles this indicator is going to be looking. If you decrease the period from 14 and make it less, it becomes more sensitive in terms of determining the ATR. But if you increase the number from 14 and you go above, let's say you put 50 or 100, it makes the indicator to be less sensitive. All right, but the 14 is just okay. It is the default setting and it's okay. On the style, just put 1 pixel because we don't need the moving average. We'll just be using the value. On the colors, if your background of your chart is white, just put white. If your background is a black one like mine, I have put black because I don't want the moving average to be visible. I only want the value for the ATR. All right, once you have said that, don't include any levels, just click done right here. Done. Now we have our ATR right here. but then you can see that it is taking much space of our screen. What we have to do is long press anywhere on the screen, and once you have long pressed, use this to adjust the position of, or to adjust the size taken by the ATR indicator. Just make it less enough, because all you want to see is the ATR value, and then you can click anywhere. Now you have your ATR indicator. All right, so what is the right ATR? Now that depends on you, but I can advise you that any ATR that's above 10, stay away from it, especially if you are new in the forex market. If you are a beginner, any ATR that's above 10, stay away from it. It's best to trade pairs with a very low ATR, like pairs that have an ATR that's less than 1. As you can see right there is 0.002. Maybe let me show you other pairs with quite bigger average true ranges. All right, let's look at the US 100 chart. You see that the ATR is 33, and that's huge. If you are a beginner, you want to stay away from that kind of, it's not really a pair, it's an index. Let's check US 30. US 30 is 57, which means it's highly volatile. It's very volatile. You want to stay away from that. Let's check gold. Gold is 3.9, quite volatile, but you can risk if you have some experience of trading. Let's look at other currency pairs like Euro USD 0.002, that's best for you. Euro CAD, it's 0.00212. You can trade that. I hope you are getting the idea. I hope you're getting the idea. That's how you can go about identifying the right pairs for you. Pairs that are less volatile, because the ones that are highly volatile are going to take much of your account in terms of risk. You'll be risking bigger percentages. If you go for the US 30, you will be incurring a very high risk. All right, so that's it for today. Please, if you like this content, please do subscribe. I still have a lot to share with you. Thank you.